think their goal of trying to grow earnings at 15+% kind of got them into their current inventory problems at the trade? And as well, the Duracell acquisition, I know at the time neither one of you were the biggest fans of the deal. I just want to know how you feel about it now.
Well, I would say it's a mistake, and I've said it, I think it's a mistake for any company to predict 15% a year growth, but plenty of them do. For one thing, unless the U.S. economy grows at 15% a year, eventually any 15% number catches up with you. It doesn't make sense. Very, very few large companies can compound their earnings at 15%. It isn't going to happen. You can look at the Fortune 500, and if you want to pick 10 names on there that will compound their growth from other than some extraordinarily depressed year. I mean, if they had a year where they just broke even, so the number is practically zero. But if you pick any company on there that currently has record earnings, and you want to pick out 10 of them that over the next 20 years will average 15% or greater, I will bet you that more than half of your list will not make it. So I think it's a mistake, and as I said in the annual report, I think it leads people to stretch on accounting. I think it tends to make them change trade practices, and I'm not singling out Gillette in the least, but I can tell you that if you look at the companies that have done it, you will find plenty of examples of people that have made those sort of mistakes. And I think that in connection with Duracell, I mean, obviously Duracell has not turned out the way that the management of Gillette at the time hoped that it was going to do, and who the investment bankers who came in and made the presentations, those presentations would look pretty silly now. Charlie?
I think that kind of stuff happens all the time. It will continue to happen. It's just built into the system. I see more predictions of future earnings growth at a high rate, not less. I mean, a few people have sort of taken an abstinence pledge, but it's very few. It's what the analysts want to hear.
It's what the investor relations departments want the managements to say. It makes their life easier, but they don't have to be there 5 years from now or 10 years from now doing the same thing. If we predicted 15% from Berkshire, 15% means that, assuming the same multiples, I mean, that means, in 5 years, 200 billion, in 10 years, 400 billion, 15 years, 800 billion, trillion six in 20 years. And the values get to be crazy. And, if you have a business with a market value of 400 or 500 billion, and you had a few of those not so long ago, just think of what it takes to deliver in the way of future cash at a 15% discount rate to justify that. If you've got a business that's delivering you no cash today and it's selling for $500 billion, to give you 15% on your money, it would have to be giving you 75 billion this year. But if it doesn't give you 75 billion this year, it has to be giving you 86 and a quarter billion next year. And if it doesn't do it next year, it has to be giving you almost 100 billion in the third year. Those numbers are staggering. I mean, the implications involved in certain market valuations really, belong in Gulliver's Travels or something. But people take them very seriously. I mean, people were valuing businesses at $500 billion a year or a year and a half ago. And there's just almost no mathematical calculation you can make that would, if you demanded something like 15% on your money, there's almost no mathematical calculation you could make that could possibly lead you to justify those valuations. Charlie, have any more?
Well, I said on another occasion that to some extent stocks sell like Rembrandts. They don't sell based on the value that people are going to get from looking at the picture. They sell based on the fact that Rembrandts have gone up in value in the past. And when you get that kind of valuation into stocks, some crazy things can happen. Bonds are way more rational because nobody can believe that bond paying a fixed rate of modest interest can go to the sky. But with stocks, they behave partly like Rembrandts. And I said, suppose you filled every pension fund in America with nothing but Rembrandts. And of course, Rembrandts would keep going up and up as people bought more and more Rembrandts or pieces of Rembrandts at higher and higher prices. I said, wouldn't that create a hell of a mess after 20 years of buying Rembrandts? And to the extent that stock prices generally become sort of irrational, isn't it sort of like filling half the pension funds with Rembrandts? I think those are good questions.
Once it gets going, though, people have an enormous interest in pushing Rembrandts. I mean, it creates its own constituency. Zone